Hello, this is Susan Hayes, the Positive Economist, and today I'm going to do another video in the series called investinginyouth.com, Introducing Wall Street to the Classroom. Now, the way I have this set up on the website is appropriate for a classroom where I have an activity sheet also attached. However, if you are looking at this from your own perspective as an investing adult, what I would say is answer these questions and put your own portfolio to the test. So, in the activity, what I did was that I said to the students, you have 20,000 euros to create a portfolio. You can choose whatever stocks you like and as many as you like, but you can't go over budget. And the transaction costs are 30 euros per trade. Now, if you are an investing adult, obviously you can't go over your own budget either, and you have already paid your transaction costs. You have as much as whatever that you have in your portfolio. So let's go from there. Why did you pick the stocks that you have? Well, first and foremost, add up the number of stocks that you have and add up the total amount that you have spent on transactions. Now, what percentage of funds are going towards transaction costs? For example, if you have a €100,000 portfolio and you have spent €2,500 on transaction costs, well then you have spent 2.5% of your fund. Now bear in mind, 2.5% is then the percentage that your portfolio has to perform in order to get back to zero, in order to break even. Now also remember that every time you sell, that you have to pay a transaction cost as well. So just work out how much it would cost you to sell all of your stocks also, and then that is the real percentage that you will need to make in the market in order to break even and to get all your costs back. Now how can you make this better? Well, very simple. All you need to do is shop around for lower transaction costs, primarily, if possible, through an online broker if you're comfortable with that, and it will be addressed at a later video. Now, how many shares of each stock do you have? Now, in this case, I'm dealing with a very well-held myth. Would you prefer to have 1,000 shares at 10 cents or 100 shares at €1? Quite often people perceive a share at 10 cents to be cheaper or to be of a lower price, etc. However, I ask you the question, what is the difference between 10% of €100 and 10% of €100? Because after all, that is what 1,000 shares of 10 cents or 100 shares of €1 is. It's not about how many shares you have, but how much money you have invested in the stock. So did you just buy shares just because you could buy many of them? And again, it doesn't matter, because it's about the money that you invest as opposed to the number of shares that you have. Did you buy value? Did you buy over, under, or fairly valued stocks? Now, it can be quite difficult to measure value, but I will be dealing with that in a later video. But from your own perception as of the stocks that you have, were they over, under, or fairly valued stocks? Now, would you expect an overvalued stock to gain in price? It's a hard question to answer, but really an overvalued stock should not gain in price, as the value is already built into the price and it is overvalued as it is. However, that's not to say that overvalued stocks don't rise, but usually when they do, they will rise and they have further to fall. Now, would you expect an undervalued stock to gain in price? Well, yes, you would expect it, but it doesn't always happen. And if it doesn't happen straight away, it may not happen for a while. This is because people may perceive it to be losing its value, despite the fact that the value is actually in the stock, and investors have yet to see it coming out. On the other hand, it may never come out because it becomes a stock that people don't follow, or various other different reasons. But you have a better chance of an undervalued stock rising than an overvalued stock. And is an undervalued stock guaranteed to increase in price? Well, it's not guaranteed. There's no stock guaranteed to do anything. So what do? Well, the best thing to do is simply buy a portfolio of undervalued stocks, as the odds are stacked far more in your favour if you do. And also, again, the issue of value will be dealt with in a later video. So have you many of one sector, i.e. financials? And this was an issue with a lot of Irish portfolios over the last couple of years, that they were heavily weighted within the financial sector, which obviously suffered a lot during the 2007 to 2009 crisis. Do you know anything about the sector that you choose? This is always an interesting question that I ask people. Perhaps they've invested in mining or they've invested in retail, and do they know anything about the sector? Personally, it's not the first thing that I look at myself, but it's important just to have an idea about what is going on in that particular industry. Is it wise to invest in just one or two sectors? Well, I go back to my old example again of the Irish financial services industry. Now bear in mind, there were a lot of industries that had fallen well in the crisis of 2007 to 2009. However, had you diversified maybe into food or maybe into commodities and other defensive stocks, well then maybe you wouldn't have suffered at all as much as somebody who had simply invested in financial services. And is it wise to invest just on the basis of sector? Absolutely not. There's no point in just buying a different sector for the sake of it. What is really important is that you, yes, diversify in terms of sector, but also that you're buying value all the time. And where did you buy geographically? What countries and continents did you buy in, and are these diverse? And what is going on in these areas? Did you just buy in Ireland? Many people would have the idea that if you buy different companies in different sectors in just one country, i.e. in our own country, Ireland, well then you are diversified. But this is really not the case, as Ireland is a very, very small, albeit open economy. So it is really important just to think outside of your own country. And is it a good idea to stick with just one country or area? Well, I think I've answered that already, as it really is not. It's important to go outside of that particular area. And is it a good idea to invest in another market just for the sake of diversification? Well, similarly to the sector, it's not a good idea at all just to do this. It's really important to look for value and then ensure that you are diversified as well. So now that you know an awful lot more about your portfolio, go back and do it again. And this is what I say to the students when they do their activity sheet and have gone through this particular analysis. But in your own case, now that you've looked at your portfolio, is there any ways that you'd like to change it? Do you want to decrease your transaction costs? Do you want to increase diversification? Do you want to sell stocks that are overvalued and replace them with undervalued ones? Really, some food for thought there. So what did you do differently? What would you do differently? But make sure that there is a very, very, very good reason for it. This is Susan Hayes, the Positive Economist.